What is up, you guys? It is your boy back with some massive financial updates that are literally breaking the internet right now. If you think your savings account or your index funds are safe just because you are doing what everyone else does, you need to wake up because the entire foundation of the American financial system just went through an absolute tectonic shift. Think about this. Just a few days ago, Kevin Warsh was officially sworn in as the 17th chair of the Federal Reserve at a historic White House ceremony. And the very first thing he is talking about is a complete and total regime change at the institution that literally controls the cost of every single dollar in your pocket. This is not just some boring administrative swap. This is a financial paradigm shift that will dictate your mortgage rate, your credit card interest, and whether the stock market enters another massive bull run or spirals into a brutal cost of living crisis. And to make things even crazier, Jerome Powell did not just pack up his bags and leave. For the first time in nearly 80 years, an outgoing Fed chair is refusing to step away from the Board of Governors, meaning we now have two massive economic titans with completely opposing views sitting in the exact same room pulling the strings of our economy. Oh shit, this is the exact kind of economic drama that leaves everyday investors holding the bag if they do not see what is coming. So today we are breaking down the exact four-part reset plan that Kevin Warsh has laid out, why the bond market is completely throwing a tantrum right now, and exactly how you need to play defense and offense with your personal portfolio piece. Let us start with the absolute craziest dynamic of this transition because it sets the stage for everything else. Usually when a new Fed chair takes the oath, the old chair politely steps aside to let the new regime run the show. But Jerome Powell announced he is staying on the board until his term officially expires in early 2028, citing what he calls unprecedented legal attacks. The last time anything close to this happened was back in 1948 under President Truman. But back then, Truman actually asked the guy to stay. This time, nobody asked Powell to hang around. He just chose to stay, which creates a massive institutional roadblock for Warsh's aggressive plans. You have to understand that the Federal Reserve is essentially a small group of highly influential people whose single job is to keep prices stable and employment high. They control the money printer. They set short-term borrowing costs, and their decisions dictate whether businesses are hiring you or firing you. Now enter Kevin Warsh, who was nominated by Donald Trump and confirmed by the narrowest margin in United States history. Warsh is a former Morgan Stanley banker who was right there in the trenches during the 2008 financial crisis. So he knows exactly how Wall Street thinks, and he thinks the current Fed has become entirely too massive, too political, and too bloated. He wants to completely strip down the central bank's footprint. And that starts with part one of his massive economic reset, which is aggressively shrinking the Fed's $6.7 trillion balance sheet. See during COVID and the 2008 crash. The Fed bought trillions of dollars in government bonds and mortgage-backed securities to flood the system with cheap money and prevent a total collapse. But Warsh openly testified that he wants to take down that balance sheet by a couple $1 trillion over time because he believes it creates massive market distortions and keeps inflation risks way too high. His logic is that if the Fed stops manipulating the bond market, investors will have more long-term confidence, which could theoretically allow interest rates to drop naturally. But here is the catch. Critics are completely panicking because pulling trillions of dollars out of the financial system is the literal definition of monetary tightening. If you siphon that much liquidity out of the market, the stock market could easily take a massive hit while borrowing costs spike through the roof. And that brings us to part two of the Warsh Doctrine, which is completely ending the era of constant warnings. For the last 14 years, the Fed has released something called the dot plot every single quarter, which is basically a chart showing where every member expects interest rates to go over the next few years. Every single hedge fund, mortgage lender, and retail trader uses that dot plot to price their financial products. And make bets. Warsh wants to throw the dot plot in the trash and cut the number of mandatory annual Fed meetings from 8 down to just 4. He believes a Fed that talks less and acts with more surprise is way healthier for the long-term economy. But almost everyone on Wall Street is terrified of this because it means we are going to see way more sudden, volatile market crashes and rallies since investors will be flying completely blind without any forward guidance. Oh shit. Imagine trying to buy a house or invest in tech stocks when the Fed can just drop a massive interest rate bomb out of nowhere without warning. On top of that, part 3 of his plan changes the literal way we calculate inflation. Under Powell, the Fed preferred core PCE, which ignores food and energy costs because they fluctuate too wildly. But Warsh wants to shift to something called trimmed averages, which basically throws out the most extreme price spikes to get a cleaner view of underlying trends. Some critics argue this is just a sneaky way to make inflation numbers look lower than they actually are, so the Fed can justify cutting interest rates faster, but it definitely does not build a lot of consumer confidence when the government changes the scoreboard in the middle of the game. Especially when you pair it with Part 4, which is the concept of earned independence. Powell treated the Fed's independence from politics as a sacred, non-negotiable rule. But Warsh says that independence is something that must be earned by hitting economic targets, since Trump has openly demanded lower interest rates to supercharge the economy. Many people are terrified that Warsh might let political pressure influence monetary policy, even though Warsh strictly testified that Trump never forced him to promise any specific rate cuts. Now, even if you do not care about central bank politics, you absolutely must care about how this impacts your actual wallet, because there is a massive misconception out there right now. Most casual investors think that because Trump appointed Warsh, we are automatically going to get cheap money and massive rate cuts any day now. But that is simply not how the world works. The Federal Reserve only directly controls short-term interest rates, like the overnight lending rate, but the rates that actually affect your daily life, your 30-year fixed mortgage, your auto loans, and long-term corporate debt are entirely controlled by the bond market. And right now, the bond market is in absolute shambles. Long-term bond yields are completely dictated by investor supply and demand. And if global investors think that Warsh's policies, combined with surging oil prices over $100 a barrel and geopolitical conflicts in the Middle East, are going to cause massive inflation, they are going to demand way higher yields up front to protect their money. This means even if Warsh cuts short-term rates tomorrow, your mortgage rate might actually go up if bond investors do not trust that inflation is under control. In fact, the markets are currently doing something wild. They are starting to price in the distinct possibility that Kevin Warsh's very first policy move might actually be an interest rate hike. Inflation is proving to be incredibly sticky, fueled by global resource pressures, and the stock market has created more massive wealth than we have ever seen in human history. The only real way for Warsh to regain the market's trust and crush inflation expectations might be to completely shock the system, drain the free money, and let the market correct itself from a clean slate. So who actually wins and loses in this wild new regime? Let us break down the clear losers first, because this next year is going to be incredibly tough if you are caught on the wrong side of the fence. First, anybody holding massive variable debt is getting absolutely hammered. Credit card rates are already hovering way above 20%, and with Warsh keeping rates higher for longer to combat sticky inflation, that debt is going to compound against you faster than ever. Second, first-time homebuyers are completely frozen out. Mortgage rates are knocking on the door of 7% again. And because Warsh wants to sell off the mortgage-backed securities on the Fed's balance sheet, the very assets that keep home loans stable, mortgage rates could easily stay elevated for years. Third, high multiple tech stocks, speculative AI plays, and growth companies that rely on cheap borrowing to fund their future profits are going to face massive repricing. When today's safe government bonds pay you over 5%, investors are simply not going to pay crazy premiums for earnings that a tech company promises to make 10 years from now. And fourth, the United States government itself is losing big time. Higher bond yields mean the interest payments on our $39 trillion national debt are ballooning into a massive deficit spiral, forcing the government to borrow even more money, which pushes interest rates even higher. But look, it is not all doom and gloom, because this regime change creates some massive winning opportunities. If you know where to park your cash, the absolute biggest winners right now are disciplined savers. If you have cash sitting in a high-yield savings account, short-term certificates of deposit, or short-term treasury bills, you are sitting on a gold mine. The 30-year Treasury yield has climbed above 5%, reaching its highest level in nearly 2 decades. You can literally lock in a safe, predictable, government-backed return without taking a single ounce of stock market risk. Second, major commercial banks' high interest rates allow them to charge massive premiums on long-term loans while paying out relatively low interest on everyday checking accounts, causing their profit margins to skyrocket. And third, the US dollar is getting incredibly strong compared to foreign currencies. While that hurts global exports, it means your purchasing power traveling abroad or buying foreign goods is higher than it has been in decades. Look, at the end of the day, my personal take on this entire Kevin Warsh drama is that the media is being way too dramatic on both sides. The reality is that Warsh inherited an incredibly complex economy with sticky inflation at 3.8%. Massive global oil shocks, a deeply divided Federal Reserve Board, and a bond market that is completely calling his bluff. Any hopes of massive cheap money returning to save the day in the next 12 months are completely dead. So here is exactly what I am doing with my own money right now. I am completely refusing to over-leverage myself on any investments that depend on interest rates dropping quickly. I am keeping roughly 20% of my total portfolio entirely in cash, sitting on the sidelines in safe accounts, earning between 3.5% to 4% interest. This gives me a massive buffer of dry powder so that if Warsh's balance sheet reductions trigger a sudden massive buying opportunity or a temporary stock market sell-off, I have the liquidity to step in and buy high-quality assets at a major discount. For the rest of my capital, I am simply staying diversified and continuing to dollar-cost average into broad market index funds every single month. Because at the end of the day, I am just a regular guy sharing my financial journey on a screen, and nobody can perfectly predict how these massive macroeconomic shifts will play out, especially with AI continuing to completely rewrite the rules of corporate productivity. The investors who win this regime change are not the ones trying to day trade the Fed meetings or panic selling their portfolios. They are the ones who build an unshakable psychological defense, keep zero high-interest debt, maintain a strong cash cushion, and let time compound their wealth while the rest of the world panics over headlines. The next official Federal Reserve meeting is happening on June 17th, and it is going to be an absolute showdown between the Warsh reformists and the Powell old guard. So make sure you hit that subscribe button right now because I will be breaking down every single update the second the data drops. Peace.